Welcome to our next video presentation. This is going to be a presentation on a currency case. The company in question is a fictional company called Diva Shoes. Diva Shoes is popular in Japan, and so it sells shoes priced in Japanese yen, but the manufacturing base is in the United States. So Diva Shoes is exposed to exchange rate risk. If the yen depreciates in value, when Diva Shoes converts that yen sales into US dollars, it'll record lower sales in US dollars. And in an extreme case where there was a large depreciation of the yen, Diva Shoes could find itself in financial distress. As we mentioned for the JetBlue case, the reason that this risk exists is because it's something to do with the business model of the company. In JetBlue, we said that the business model relies upon JetBlue selling tickets for up to 12 months in advance and locking in the price. The risk exposure comes because JetBlue doesn't necessarily know in advance what the cost of jet fuel is going to be up to 12 months in advance. So JetBlue could enter into options contracts or futures contracts in order to get some deal that has a positive payoff to JetBlue in the event that fuel costs rise. Well, in Diva Shoes' case, there's something in the business model which also causes the risk. It's just the shoes happen to be popular in Japan, and if there is a depreciation of the yen, or in other words, an appreciation of the US dollar, that doesn't necessarily mean that Diva Shoes could just increase the price of its shoes in the local market in yen because it's competing with other people who might not have the same cost base in US dollars. So maybe Diva Shoes wants to mitigate its risk by entering into options contracts or forward contracts. So we're going to consider options contracts first. And here's our situation. First of all, we want to discuss whether hedging is a good idea. We want to make a conceptual argument for hedging exposure to exchange rate movements for Diva Shoes and make a conceptual argument against hedging exposed to exchange rate movements for Diva Shoes. So the argument for hedging exposure, we have to say, is predicated on there being some concept of a market imperfection. The key point we emphasised with JetBlue was that in the absence of there being any market imperfection, volatility in cash flows and earnings doesn't matter. In a perfect capital market, we have some years where profits are low and equity holders, or negative, and equity holders just put more money into the business, and some years where profits are high and equity holders take money out of the business. But markets aren't perfect. And the specific market imperfection we identified for JetBlue is what happens when a company becomes financially distressed. Financial distress in itself isn't the market imperfection. The market imperfection comes because in financial distress, customers, managers and employees start behaving in unusual ways because the firm's operating in a distressed state. Customers are less willing to buy plane tickets on airlines which are financially distressed because maybe the plane doesn't fly. Employees start behaving in suboptimal ways. They're less efficient because they are worried about their jobs, so they're distracted and they're quite rationally looking for new jobs. And executives start behaving in suboptimal ways as well. They might behave in an optimal way given the situation by reducing maintenance costs or reducing IT expenditure, but on average, this is a suboptimal decision because they're going to have to spend more on IT later. The systems are going to get slower, so the customer service operations are going to be less efficient. They're going to have to spend more on maintenance later. There's more risk that a plane would be grounded because of a fault. So in a normal situation, these would be suboptimal decisions. So could that happen to Diva Shoes? So for Diva Shoes, there's no problem if Diva Shoes has an unlimited supply of capital. It doesn't matter whether in the short term the yen depreciates, so earnings are low, because on average Diva Shoes is still going to sell the shoes for the average yen US dollar exchange rate over a period of time. However, Diva Shoes likely has a reasonable degree of fixed costs in its manufacturing base. Diva Shoes is likely paying rent at a factory, or it owns a factory, so it's losing the opportunity cost to sell that factory to someone else or lease it to somebody else. And for manufacturers, they rely upon having enough capacity, enough production capacity to operate at economies of scale. Once a factory is operating at only 70 or 75% of capacity, you are probably not getting enough economies of scale, enough per unit of production to amortise all the fixed costs associated with running a factory. Those fixed costs include depreciation or the rent if you own the factory. You've got machines in there that only have a particular number of years of useful life, even though they're going to have less life if you produce more. And you're going to have some workers which are paying variable wages and some workers that you're paying fixed wages. And so because a short downturn could mean that Diva Shoes can't cover its fixed costs, the question is whether enough equity can be injected into the business on average over a period of time for Diva Shoes to be around when it returns to profitability. In the worst possible outcome, if Diva Shoes has taken on some debt, Diva Shoes could become bankrupt and not be in operation when the yen exchange rate recovers. It is also exposed to the same financial distress risks that the airline JetBlue is exposed to, although those are less prevalent because customers are not going to behave in the same way that they would for an airline that becomes financially distressed. But executives and employees are still going to start to behave in suboptimal manner. So the key point is that you want to hedge your exchange rate movements if there is going to be a material, prolonged and asymmetric impact on the business from having the yen depreciate versus having the yen appreciate. And if Diva Shoes could identify something which has a material, prolonged and asymmetric impact from the exchange rate deteriorating, that's a justification for some hedging. The argument against hedging is that we can just bear as owners some variation in profits. It could be the case that Diva Shoes can reduce its costs if sales decline due to a depreciation of the yen. So Diva Shoes would have to look quite carefully at what its cost base is to decide how much true exposure do we actually have. Do we in fact not have much exposure to this exchange rate fluctuation because our costs can decline? So that's the conceptual debate that you want to have as an executive when you're thinking about hedging. So the example we're going to work through is to first assume that Diva Shoes is unhedged. Actual and projected sales for a 6-month period are going to be 3.6 billion yen. The actual and projected costs are going to be half of the cost from Exhibit 5 in the case, which are annual numbers. They're going to be denominated in US dollars. Our projection is that the exchange rate is going to be 90 yen equals 1 US dollar over the 6-month period. We're also going to project that the realised 6-month average exchange rate and the ending exchange rate is going to be 70 yen equals 1 US dollars. There's a minor typo in my slide, but it's going to be 70 yen. So we're going to first model a situation in which the yen depreciates compared to what we were anticipating. Then we're going to compile 2 6-month income statements. There's going to be a projected income statement and there's going to be a realised income statement. Secondly, we're going to assume Diva Shoes is going to be hedged from buying enough options to buy US dollars for all 3.6 billion yen in sales. So we're not going to assume any volume risk here. Diva Shoes is still going to sell 3.6 billion yen in sales, and we're going to compile a 6-month income statement that incorporates 2 additional line items. The cost of the hedge, that is the cost of buying the options, and the payoff from the hedge if in fact the option finishes in the money. Then we're going to repeat our analysis for the flip side. We're going to assume that the realised 6-month average exchange rate is 110 yen equals 1 US dollar, and that the realised ending 6-month exchange rate is also 110 yen equals 1 US dollar. Now, side note, I mentioned in this example here that we're talking about the average exchange rate over 6 months and the ending exchange rate over 6 months. And in this example, I've set those figures to be the same. So in the first situation, we have an average exchange rate over 6 months and an ending exchange rate over 6 months of 70 yen equals 1 US dollar. We then have a situation where the average exchange rate and the ending exchange rate is 110 yen equals 1 US dollar. But you could have an alternative situation where the average exchange rate over time is different to the ending rate. And that could expose Diva Shoes to more uncertainty about how much to hedge. Because suppose Diva Shoes sold shoes continuously over a 6-month period. That means it's really exposed when it converts its yen to US dollars at the average exchange rate over 6 months. But call options are typically not written in relation to the average rate over a period of time. They can be written in that way, but they're not always written in that way, and it's not the most common way of writing a call option. So if Diva Shoes writes a call option to convert yen to US dollars based upon the ending exchange rate after 6 months, that won't necessarily be the complete hedge when Diva Shoes is selling yen over a 6-month period. But we're not going to consider that in this particular case. We're not going to consider the difference between average rates and ending rates. That's just for simplification. But just be aware that that difference could exist and it could expose the company to more uncertainty about how much to hedge. So we're going to stop at that point there. In the next part of this presentation, I'm going to get into the actual computations, and we're going to work through those computations with reference to the spreadsheet that I've prepared on Diva Shoes. I will talk to you then.